This is the financial focus portion of this webinar. So we've just talked about a lot. We spent a half an hour together talking about updates from the Slott group that affect your IRAs, Roth IRAs, conversions, rollovers, and all of that. We had some updates from Heather Schreiber's Social Security report. We're going to talk more about Heather in this portion. And we had market updates. So if you want to, you can go back and look at that weekly webinar. If you're just here for the financial focus, dig in. We're going to talk about, does the new tax law eliminate or reduce your Social Security tax? So let's see what the answer is to that. So I'm going to share my whiteboard, and we're going to walk through this a little bit. So what happened here? Why is this such a big topic right now? Well, I shared with you in the beginning of this webinar that I had a completely different topic lined up and in mind that also had to do with Social Security, but it had to do with claiming strategies. But then on July 4th, last week, 2025, so I don't know when you're listening to this, if you're listening to the recording, but it is July 9th, 2025. So just last Friday, the One Big Beautiful Bill Act was signed into law. And one of the things that it changes is overall taxation for seniors. I'm going to say that. But what's the headlines are saying a reduction or elimination of tax for Social Security. Now, I read that with some skepticism, thinking, okay, well, let me look at this, and because it didn't seem to me to be a direct impact on tax for Social Security. And then I received an email from a quote-unquote Social Security expert, not Heather, somebody else who calls himself a Social Security expert, and he kind of misunderstood or mischaracterized the effect of this bill. So I read it a couple times, and I reached out to Heather. So Heather's our Social Security strategist. She's one of the best in the nation, and I met Heather through my affiliation with the Slott group several years ago, and she, I brought her on. It's been a few years now on a retainer basis to be part of our team, and she reviews Social Security claiming strategies for each one of our clients, and that's extremely helpful. But it's also helpful just to have her expertise on the team, because I had a lot of conversations with Heather over the past few days about this. And she said to me, thankfully, she said, because I'm going to refer to this newsletter, she said, hey, I'm typing up the newsletter right now about this because it's so important. There's so much misinformation out there. So, I've had these conversations with these experts and colleagues, so that I've been talking to colleagues about it too. And some colleagues are completely misunderstanding it. And advising their clients, hey, you don't have to pay tax on Social Security anymore. And some are pretty close, but their calculations are wrong. They're pretty close, but it's not quite there. But we've been having I've been having these conversations with experts and colleagues, and I wanted to help clear the air a little bit. So hopefully this does. So let's just go through the list here. So what is the new law? What is the new law? Well, there's a lot to the, it's huge. It's a huge law. So it's we're talking about the One Big Beautiful Bill Act, and it's enormous, and there's a lot of changes. But here in this section, we're talking about the potential effect on Social Security taxation. So what this does is it allows for an increased deductions for taxpayers age 65 or older. So age 65 or older. But this is only for tax years 2025 through 2028. And then it's also reduced based on your modified adjusted gross income. So I'm going to talk about that more in a moment. Well, let's just go into it. So I'm going to come over here. So this is an excerpt from Heather's newsletter that she does. And this just came out yesterday. So let's give Heather the credit she deserves. But she writes, beginning in 2025, seniors age 65 and older may deduct up to $6,000 or $12,000 for joint filers. This deduction is reduced by 6% of modified adjusted gross income, or MAGI, over $75,000 for single filers, or $150,000 for married filers. It phases out entirely to $150,000 or $250,000 respectively. It applies after adjusted gross income is calculated, is in addition to the standard deduction, and does not lower MAGI for purposes of calculating income-related monthly adjustment amount, or IRMA, surcharges for Medicare. So it's not going to affect that at all. But that's how it's written, right? So it's an additional $6,000 per person. So if you're a joint filer, age 65 or over, for a limited period of time, then it's 12,000, right? So 6,000 times 2, and this is on top of the standard deductions already that we have now. So that's a good thing. In truth, she writes, in truth, the statutory framework governing the taxation of Social Security remains unchanged. The new deduction is a temporary tax benefit, not a structural policy shift, because the Byrd rule prohibits, and we're going to talk about that a little bit more, prohibits changes to Social Security's benefit formula or trust fund financing in reconciliation legislation. The campaign era pledge to eliminate benefit taxation, she's talking about Social Security benefits, taxation could not be enacted via the One Big Beautiful Bill Act. So let me come over and go back to here. So what is not in the new law? So Heather just told us. So we know what is in the new law, right? Increased deduction for taxpayers age 65 or older, but only for a limited time for tax years 2025, 26, 27, and 28. And it's reduced based on modified adjusted gross income. So you can see that here. We just went through that. I'll hold that there for a second if you want to take a screenshot of it. What is not in the new law? Changes to the formula that determines tax on Social Security. That's called provisional income, or what we call PI. And why? Because, well, there's probably a lot of reasons why, but primarily because, like what Heather talked about, the Byrd rule. So that was from Senator Byrd, and the Byrd rule says that you can't make these significant budgetary changes to during reconciliation. Now, let me see. I think I have information on that. Let me see. I thought I posted it in here. So anyway, that's what the Byrd rule says. So the Byrd rule says that you can't make significant changes to Social Security and other budgetary things in the reconciliation. So reconciliation is if you don't have the 60 votes required in the Senate to pass a bill. Normally, you go through this reconciliation process, and it's limited, and that's why we see things like these restrictions on dates. You know, like this new deduction is for a limited period of time. Other things are a limited period of time. It's, the Tax Cuts and Jobs Act had a 10-year sunset at 12/31/2025 because that was via reconciliation. So if you can't get the support of at least 60 senators, then you've got to do it a little differently. And that this reconciliation is what is how we got the One Big Beautiful Bill Act. So let's talk about provisional income and why and what's not in the tax law. So these are the provisional income brackets. So provisional income is the income that Social Security tracks, or the IRS tracks, to determine how much of your Social Security benefit is taxable. So these brackets are pretty easy to remember. Let me get myself out of the way here so you can see the whole thing. There you go. All right. So these brackets are pretty easy to remember because they haven't changed since, I think it's 1983, but it's certainly the early 80s. So if you're, this is for a single filer up here. This is married filing joint. So if you're, let's just go with a married couple here. If you're under $32,000 in provisional income, so provisional income can easily be, you can easily, the formula simply is modified adjusted gross income plus 50% of your Social Security benefit. Yeah, you got to add that back in. I know. And then plus tax-free interest on municipal bonds. So any tax-free, if you're just listening to the podcast, I'm air quoting, and you all can't see me anyway because I took myself off the screen. But I am air quoting tax-free municipal bonds because you have to add that interest back in for that inclusion of provisional income. So it's modified adjusted gross income plus 50% of your Social Security benefit plus tax-free interest. So if all that adds up to under $32,000, then you don't pay any tax on your Social Security. If it's between $32,000 and $44,000, up to 50% of your Social Security benefit is subject to tax. Above $44,000, up to 85% of your benefit is subject to tax. So that hasn't changed. That hasn't changed. Again, I think it's been 1983. Now, the problem with this is that more and more people are subject to tax on their Social Security because these thresholds were put into place decades ago, when I was still in high school, and incomes have increased. So what we should do is we should make, if we really want to affect change to Social Security taxation, then we should make changes and updates to the provisional income tables and allow for increases based on some cost of living adjustment. So let me see if I can bring myself back in here. So, but that didn't happen. That didn't happen with this act because, like I said, because they can't make changes to this portion of the code without having the full majority of the Senate. So we're back to that Byrd rule limitation. So that's what's changed, and that's what haven't changed. So now we're working with the same formula with Social Security. So did the One Big Beautiful Bill Act reduce the tax portion of your Social Security? The answer is no. Could it reduce or eliminate the tax you pay on your Social Security benefit? Well, maybe. Maybe it could, and it's based on your age, your income, and it's for a limited time. So the reason I say that is if you qualify. So if you're first of all, you have to be over 65. You have to be over 65 to have this apply to you. And it's only for tax years 2025, 26, 27, and 28. So it's only for a limited period of time. And you can't make too much money. So if your modified adjusted gross income falls over these thresholds, then you have a phase out or an elimination of this additional $6,000 for individuals, $12,000 for joint filers. So it might reduce your benefit. So I've got an example here, and the best example I found simply. So I've been spending a lot of time on this. The best example I found was, believe it or not, on Instagram. So I had planned on writing out an example, and I wanted to get to, kind of a zero tax on Social Security example here for you. But I was going through yesterday, scrolling through different things, and I follow a lot of financial stuff on my social media, and there's a person called Money Cruncher that I see on or a post all the time, Money Cruncher on Instagram. So I want to give him credit because I just thought it was a great example. So let me run through it with you. So here's an example of where this does eliminate tax. It's really not just the elimination of Social Security tax. It's eliminating if you qualify for this additional deduction, you eliminate tax over all. Therefore, it may eliminate or reduce your Social Security tax. I hope you understand what I mean, but I hope this illustrates it. So let's do a married couple, both age 65. Their total income is $95,000. Now, I'll just tell you right off the bat, and we were having a meeting yesterday, and our CPA, Sasha, said this, it's not going to affect most of our clients because your income's higher, your modified adjusted gross income is higher. So your benefit of this additional amount for this limited period of time might be very, very small, if at all. But let's see a couple it may work out for, just so you understand how it works. So they've got $70,000 combined of Social Security benefit. This is very, very simple, but it works well, of Social Security benefit. The taxable portion of their Social Security benefit, based on their provisional income calculation that I just shared with you, is $19,600. So that's taxable. That's not the tax on the Social Security benefit. That's the taxable portion of their Social Security benefit. After you add up their income, take 1/2 of their Social Security benefit, and then any tax-free interest, otherwise tax-free interest, that gets added back in for provisional income. They have a pension or other income. It could be anything. Other income. In this example, it was a pension, taxable income, we're going to call it. Other taxable income. So then their total income here is $44,600. And so that's their line 9 on the 1040 income. And then their standard deduction, because they're both over 65, is $33,200. So this is the old way, right? This is the old way. Before July 4th. $33,200. that takes their taxable income. So you subtract this from this. That takes your taxable income to $11,400. Most people, now go back to the standard deduction for a second. This is their standard deduction. Then this is prior to One Big Beautiful Bill Act. The standard deduction is if you don't itemize and your itemized deductions aren't over what the standard deduction would be, then you use a standard deduction. It's pretty simple, and most people that we see that are over 65, that's what they're doing. They're using their standard deduction. So then $11,400 is their taxable income, and that makes their tax. Then we've got one. Based on this amount, you think about it. This amount flows into that graduated cylinder, right? So we start with, let's take me out here, 10, 12, 22, 24, 32, 35, and 37. So this is the amount. The taxable income is the amount that flows into here, and then they're taxed at whatever rate they land at, right? So their tax on that $11,400 is $1,140. So they're clearly landing in the 10% tax rate here. So now that's prior to OBBA, the One Big Beautiful Bill Act. I'm really interested to see how we're going to communicate this in the future. All right, so now if we add $12,000 to this standard deduction, this is pretty simple. Let's make this green. Let's make it a little easier. So we're gonna add $12,000. So this is now with OBB, One Big Beautiful Bill Act. So we add that $12,000 for anybody over 65 who qualifies, right? Their modified adjusted gross income is below the thresholds here. So this couple qualifies. Well, if their taxable income is $11,400, this $12,000 is going to wipe out that $11,400. So their tax is actually going to be zero. So here is an example of where someone could say, well, geez, before I was paying tax on my Social Security, but now I'm not. Well, in reality, it's the totality of it, right? It's the totality of their taxable income, whether it's from Social Security, whether it's from their income combined. It's this additional deduction below that line that is creating the reduced tax. It's not reducing anything with this provisional income, not changing anything with this provisional income. So there is not a direct correlation to anything in the One Big Beautiful Bill Act and reduction or elimination of Social Security tax. It all has to do with the increased amount that's available to some seniors who are over 65 for a limited period of time, who don't make what the government deems as too much money. So the federal government is saying that the White House Council of Economic Advisors, they're saying the enhanced deduction may increase the share of seniors paying no federal tax on Social Security benefits to as much as 88%. However, this benefit is limited in duration and reach. Again, this is from Heather's newsletter. Some younger retirees, particularly those 62 to 64, may be disappointed to discover that the deduction applies to them, and others may mistakenly assume that the change permanently alters how benefits are taxed. Neither of those things are true, right? So it doesn't apply to people 62, 63, 64, only those over 65, and it is not a permanent reduction in tax, nor is it a significant change or any change in how Social Security is taxed. Could it reduce your overall tax, therefore your overall taxable income by another $6,000 if you're single and over 65 and meet the income requirements, or $12,000 as a married filing joint couple if you're over 65 and meet those income requirements? Yes, it could for a limited period of time. So I hope that, geez, I know it's confusing. I hope that's helpful. I hope that brought some clarity to this confusing topic. Now, the reason it's so confusing is that, kind of the message that's being delivered about it, that it's a reduction of Social Security tax. And it is not a reduction of Social Security tax. It's technically a reduction of all income that's taxable because of the additional deduction for some seniors for a limited period of time. And could you just apply that to the Social Security portion of the tax? Sure. Or it could be part of your tax on your pension or part of your overall tax, however you look at it. So I hope it's beneficial to you. I hope this information was helpful. If you have any questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you have at least $1 million in retirement assets and you want to schedule time with me, you can also reach out to us at questions@attleborowealth.com. We will have a webinar next week, and I am looking forward to it. And I'm looking forward to seeing you all again. And I hope you all have a great week. Take care. Bye-bye.